Purchasing ETF options is one way to gain leveraged exposure on the broad equity market. But savvy traders also understand that options on futures are another way to gain similar exposure to the same market. Let's look at an example using two comparable traders. Craig and Caitlin both expect the S&P 500 to make positive gains. Both would like to limit their downside risk. Additionally, Caitlin wants the ability to trade around the clock. One way both traders could accomplish this is by using options. Each trader has a brokerage account worth $20,000, and both plan to commit no more than $1,500 for this trade. In this example, we will assume that the market for the S&P 500 is currently at 2,300. Craig considers buying an SEC-regulated SPY option. Caitlin is looking at a CFTC-regulated E-mini S&P 500 options, product symbol ES. Caitlin knows about SPY options, but she wants the ability to trade nearly 24 hours a day. After all, it's a global economy, and market events can impact prices any time of the day. For our example, let's assume the S&P 500 index is 2,300, and the SPY ETF is about 230, while the ES future is at 2,295. Each SPY option has a 100-share multiplier, so the notional value for each SPY option at 230 is $23,000. Craig is looking at the Feb 230 call option on SPY priced at $2.50. If he buys 5 options, it will cost him 5 times 250 times 100, which equals $1,250. The notional value of the 5 SPYs is 5 times $23,000, or $115,000. Caitlin is looking at the Feb ES options strike at 2295. ES options settle into one ES future, which has a $50 multiplier, so the notional value for each ES option is $50 times the index. With the index at 2,300, her notional value would be $115,000. Assuming the equivalent Feb ES 2295 call option is trading at $25, if Caitlin buys one 2295 call option, she spends $25 times the 50 multiplier, which equals $1,250. Both traders submit their orders, which are executed immediately. Caitlin had $20,000 in her futures account at her FCM. Her account will now show $18,750, which is $20,000 minus the cost of the trade of $1,250, and she is long one ES Feb 2295 call option. Craig's account will show a similar balance of $18,750, and he is long 5 SPY Feb 230 call options. In February, when contracts expire, the S&P 500 index has risen to 2,400. The futures are now trading at 2,395 and the SPY is 240. At expiration, Caitlin's option is in the money and exercised at 2,295. Caitlin now owns one ES March futures contract, which she paid $2,295. The March futures is currently priced at $2,395. That's a 100-point gain. If you times that by the $50 multiplier, you get $5,000. Add that to her existing account balance, and you have a new account balance of $23,750. And she is still long one ES March futures contract. Because she now has a futures position, she will be required to post margin. Assume the E-mini S&P 500 futures requires initial margin of $5,280 per contract. The FCM will see that Caitlin's account has more than enough to cover that required margin. This leaves her with $18,470 excess capital. Now let's look at Craig's position at expiration. With the SPY trading at 240, Craig's option is in the money and is exercised. He now must pay for 500 shares of SPY at $230 per share, which costs $115,000. Assuming his account is subject to 50% margin, his account must have half of $115,000 or $57,500. His current account balance is $18,750, so he needs to borrow an additional $38,750. What would you rather be doing? Preparing to manage your next move with your excess capital, or having to find additional funds to keep this trade alive?